September 2008, a financial titan, a 158-year-old bank, crumbled into oblivion overnight. $600 billion vanished, retirement funds evaporated, and millions of jobs were wiped out. Yet, what if I told you the true genesis of this catastrophe began with a deceptively simple lie? A slogan so brief it could fit on a billboard. Why rent when you can own? Fast forward to 2002. The economy was still reeling from the dot-com bust, and the 9/11 attacks had just delivered a devastating blow, leaving Wall Street decidedly jumpy. But fear not, the Federal Reserve unveiled its grand strategy. Drastically slash interest rates, practically to zero. Boom. Money became incredibly cheap, borrowing effortlessly accessible. Suddenly, America's favorite national pastime wasn't baseball or apple pie anymore. It was buying a house. Congratulations. You're approved for $500,000, but we only make $40,000 a year. Not a problem. We have adjustable rate mortgages, balloon payments, even ninja loans. Wait, what's a ninja loan? No income, no job, no assets, no problem. You see, in the early 2000s, homeownership transcended mere shelter. It was the quintessential American dream, symbolizing stability, status, and suburban bliss. The message, relentlessly propagated through every advertisement, billboard, and mortgage seminar, was unequivocally clear. Why rent when you can own? Banks enthusiastically echoed this sentiment, so much so that they began dispensing money as if it were a high-stakes game show where everyone was a winner. This ushered in the era of the subprime mortgage. Translated, subprime meant loans for individuals with poor credit, unstable incomes, or a rather vague understanding of personal finance. Bad credit, no credit, living in a van down by the river? You, sir, absolutely qualify for a luxury condo. Should I be worried about actually paying this back? That's not your concern. If you default, we'll just sell the house for an even higher price. It was a housing gold rush, an absolute frenzy. Everyone was buying, and prices skyrocketed at an unbelievable pace. Your neighbor's house doubling in value in 6 months? Perfectly normal. Even part-time McDonald's employees and baristas with pocket change and savings were somehow approved for mortgages. This was just a typical day in the mid-2000s. And the rules? Oh, those were tossed straight out the window. Traditional lending standards were deemed too slow, risk assessments too tedious, and down payments entirely optional. If you had a pulse, you qualified for a mortgage. People were acquiring houses as casually as buying instant ramen. Lenders printed loans like monopoly money, and mortgage brokers raked in commissions faster than they could even utter the word bubble. Beneath all the buzz and relentless activity lay an unshakable, almost blind faith that housing prices would forever climb upward, simply because they always had. But beneath the gleaming open houses and polished granite countertops, a chilling question lingered. What could possibly go wrong? Spoiler alert, everything, and we're just getting started. By 2005, purchasing a home was no longer about establishing stability. It was about flipping it like a pancake, hoping the next buyer would pay double. Real estate had ceased to be a form of shelter and transformed into a speculative lottery ticket. I teach phonics during the day and buy condos at night. I just bought my third house with zero down, and I don't even live in any of them. Here's your latte. Sorry it took a minute. My bank just called and offered me another penthouse in Miami. This wasn't mere investing. It was a national obsession. Buy, flip, profit, repeat. And the more people joined this mad dash, the higher prices soared. The higher they soared, the more people rushed in, creating a self-perpetuating cycle. It was like attempting to extinguish a fire by dousing it with gasoline, and seemingly everyone had a match. Yet, beneath that red-hot exterior, a silent rot festered. Those subprime mortgages everyone was gorging on were unequivocally toxic, high risk, minimal documentation, barely verified debt. But Wall Street, ever the conjurer, had a magic trick. They bundled all that financial junk together, slapped on a deceptive label, and marketed it to investors as absolutely safe, introducing mortgage-backed securities now with 80% more lies. How do you transform toxic loans into seemingly precious gold? It's simple. You get the ratings agencies to stamp them with a coveted AAA. This bundle contains bankrupt baristas and unemployed gym bros, Ah, seems perfectly all right. AAA it is. Here's the crucial detail they conveniently omitted from the brochures. These very ratings agencies were being paid by the banks whose products they were supposedly evaluating. It's akin to hiring a food critic, then informing them they won't receive payment unless they declare your raw chicken Michelin-starred. Behind closed doors, even the raters themselves knew these bundles were nothing short of a ticking time bomb. But Wall Street wasn't done cooking. They took those inherently shaky mortgage bundles and meticulously blended them into something even more intricate and opaque: collateralized debt obligations, or CDOs. Through a kind of financial alchemy, these garbage loans were miraculously transformed into investment-grade assets. Not everyone, however, was fooled. A handful of perceptive investors, the oddballs, the skeptics, the troublemakers, actually bothered to read the fine print. They saw the decay infiltrating the heart of the boom, and instead of joining the buying frenzy, they posed an audacious question. What if we bet times against times it? The problem was, no financial product existed that allowed them to do that. So, they marched into Wall Street's formidable marble fortresses and declared, "These loans are garbage. We want to short them. Can you build something that pays us if they go bust? You want to bet against the housing market? That's adorable. Fine. You want insurance? We'll write it. You pay us monthly. And when nothing happens, we'll simply pocket the premium. Everyone wins, especially us." I mean, it's not like the whole system's going to collapse, right? Wall Street, ever opportunistic, smelled easy money. They didn't genuinely believe these contrarian investors, but they loved the prospect of collecting steady fees on something they considered an infallible bet. So, they got to work, crafting the very instrument that would ultimately ignite the world economy: credit default swaps. These were insurance contracts designed to pay out if those mortgage-backed investments went sour. The truly bizarre aspect was that you didn't even have to time zone times the underlying investment to buy the insurance. It was like purchasing life insurance on your neighbor's grandmother, then secretly rooting for her to slip down the stairs tomorrow. The entire system was a precarious Jenga tower constructed from lies and leverage. Every block represented a bad mortgage. Every successive layer, a bigger, riskier gamble. And at the very pinnacle, toasts were being made to yet another record bonus. Who needed ethics when easy money was flowing so freely? Whistleblowers were systematically ignored. Regulators were dozing at the switch, and the individuals at the helm were too rich to care, too greedy to ever stop. The party raged on, even as the floor quietly cracked beneath their dancing feet. At first, it was merely a whisper. A missed mortgage here, a foreclosure there, a vacant condo sitting idly in Vegas. But then came the tidal wave. Suddenly, the unthinkable became the stark headline. Home prices are falling. Housing always goes up. It's basic economics. That's not supposed to happen. For years, the housing market had been a Jenga tower, meticulously built from lies, leverage, and wild optimism. But in 2007, someone, or rather, a multitude, pulled the wrong block. The subprime loans, those risky, rotten deals adorned with financial tinsel, began to implode. And the mortgage-backed securities constructed upon them? They were ticking time bombs that finally detonated. Banks that had confidently stuffed their portfolios with supposedly safe assets suddenly realized they were holding radioactive garbage. The AAA-rated bundles? Actually, they were financial plutonium. We can't sell this junk. The market has vanished. But that means, yeah, we're screwed. Panic spread with the speed of wildfire. Hedge funds began bleeding money. Investment banks started slashing billions in losses. And then the ultimate boom. Lehman Brothers, a 158-year-old institution, was gone. No bailout, no heroic rescue. Just a $600 billion crater in the very heart of Wall Street. The message was chillingly clear. If Lehman could die, anyone could. Overnight, banks completely ceased lending to each other. Credit markets froze solid, as if someone had abruptly yanked the power cord on the entire global economy. I need a loan to make payroll. Sorry, no liquidity. What does that even mean? It means we're closed. Good luck. Everything jammed. Families couldn't secure mortgages. Businesses couldn't make payroll. Investors couldn't cash out their holdings. Retirees watched their pensions evaporate in real time. 401ks were toast. Life savings annihilated. And the job market simply vaporized. By late 2008, it was full collapse mode. Millions were unemployed, foreclosures surged through the roof, and eviction notices piled up like junk mail. Soup kitchens, places offering sustenance to the hungry and homeless, couldn't keep pace with demand. Unemployment offices resembled disaster relief camps. This wasn't merely Wall Street burning. This was Main Street in a terrifying freefall. And the devastation didn't stop at the US border. Iceland's major banks collapsed. Tokyo stocks plummeted. European leaders scrambled frantically to respond. From London to Reykjavik, Tokyo to Sao Paulo, markets crashed, banks buckled, and global economies spiraled into chaos. The question was no longer who's next. It became, is the entire system utterly broken? The Great Recession had officially begun. The US government faced an impossible choice: let it all burn, or inject billions of taxpayer dollars into the very financial institutions that had lit the match. In October 2008, they chose the latter. I need $700 billion. For what? To shovel into burning banks before the whole thing explodes. Enter TARP, the Troubled Asset Relief Program. Essentially, they were handing Wall Street a $700 billion cushion to break its fall. Why? Because these banks weren't merely too big to fail. Allowing them to collapse would drag down the entire global economy. So, the government did what it felt it had to do. It started chucking money out of helicopters. Seriously, whether in the form of loans, bailouts, or stock purchases, it didn't matter. If your balance sheet was smoking, Uncle Sam arrived with the fire hose. But it wasn't just banks receiving this golden treatment. AIG, the insurance behemoth that had bet trillions on garbage, received over $180 billion in aid. Even auto giants GM and Chrysler got a combined $80 billion. It was triage on a scale not witnessed since the Great Depression. Meanwhile, at the Federal Reserve, Chairman Ben Bernanke was busy rewriting the rules of economics with a money cannon. Interest rates were slashed to near zero, making borrowing essentially free. And then came the monumental quantitative easing, which meant the Fed began printing money out of thin air to purchase bonds and mortgage-backed junk. Think of it as patching the Titanic with $100 bills. Don't worry, let me cook. And guess what? It sort of worked. Markets gradually calmed. Banks unclenched. The stock market bottomed out in March 2009 and slowly began its agonizing crawl back. Wall Street exhaled, but Main Street was still choking on smoke. The aftermath was brutal. Unemployment soared to 10%. 8 million jobs evaporated. 4 million homes were foreclosed upon. And a staggering $19 trillion in household wealth vanished. Families who had never missed a mortgage payment suddenly owed more on their homes than the homes were worth. And people were incandescently pissed off. Wall Street bonuses are back. I just got evicted, and they get a bonus? The people who caused the collapse got bailed out. The people who lived through it got pink slips and food stamps. Wall Street popped champagne. Main Street stood in line for soup. And then came the collective rage. 2011. Zuccotti Park, New York City. Thousands gathered, erecting tents, beating drums, waving cardboard signs. One famously read, "We are the 99%. It was no longer solely about the bailouts. It was about a system perceived as rigged to protect the powerful, a system of privatized profits and socialized losses, marked by a profound absence of justice. No major Wall Street CEO ever went to jail. No handcuffs, no perp walks, just golden parachutes and quiet retirements. The financial system ultimately survived, but public trust burned to the ground. A generation grew up internalizing a stark lesson. When the banks mess up, they get rescued. When times mess up, you get wrecked. Because if 2008 taught us anything, it's that the next crisis won't necessarily resemble the last one. It will likely appear harmless, profitable, and inevitable. Until suddenly, it isn't.